In this session, let's start looking at the asset-backed securities ABS sector, which is also a prominent sector in line with the mortgage-backed securities sector of the bond market. The only difference between these two sectors is these are securities with the underlying mortgages as the major collateral, whereas ABS comprises of securities which are non-mortgage related assets. So they could go under vehicle loans or student loans or home equity loans or credit card receivables, any other assets backing securities which are created with backed by any other assets as the collateral, they are treated as the ABS market. So mortgage itself has completely different characteristics from other loans. Housing loans have a completely different characteristics from the other loans. That's the reason we have two completely different kind of products that are dealt with. MBS completely deals with residential and commercial mortgage as the underlying collateral, whereas the ABS market completely deals with, let's say, vehicle loans, credit card receivables, all these things as the collateral. So there are quite a different number of features, risks associated with each one of them. So that is what would be the content of this particular session. So just to get into this, the first thing that we would look at is any kind of securitization transaction, especially the creation of ABS or any other securitization transaction. How does it get into picture? So there is initially it starts with a seller who initiate the loan process. So probably when we are looking at uh, when we are looking at a bank initiates the loan process to the customer, and this loans whatever initiated by the bank. So here I can talk about auto loan or student loans or any of them. The bank is initiating this loans. So bank is called as the seller in this case, and this bank sells all these loans to a special purpose vehicle which is completely designed for the purpose of creating asset backed securities. So generally we call this particular party as ABS issuer, which is generally a trust, which is a special purpose vehicle which buys the loans from the bank, and it creates ABS out of that asset backed securities. And these asset backed securities are in turn sold to the investors. This asset backed securities are in turn sold to the investors. So investors invest in the same, and investors invest in the same, and this amount which is funded by the investors is used by the trust to buy the loans from the bank. Now as the borrower pays, as the loan borrower pays the principal as well as interest, the parties who are the investors will be compensated accordingly. And of course this payments and this is taken generally by the servicer who is responsible for collecting the loan payments from the borrowers. So, as and when the payments come from the borrowers in the form of principal and interest, the cash flow, whatever is received after the payment of the servicing fee to the servicer, whatever the principal and the interest payment that come, they are distributed to the investors. Of course, they can be distributed as it is, or various instruments can be created, like by creating various tranches or various classes of instruments based on the risk levels of the investors. So, some portion of the principal as well as the interest payments will be allocated to them. So, this kind of flow of funds is what we call as the waterfall structure with respect to ABS. So, as I said, most of the ABS, all other kinds of loans, any securities created with the backing of any other kind of loans like vehicle loans, auto loans, or credit card receivables, or we will deal about this home equity kind of loans or manufacturing houses based loans, student loans, small business loans, all these things, or even corporate bonds. All these things come under the asset backed securities kind of a market. Now, another key thing that is associated with asset backed securities is, always when you are talking about asset backed securities, it's better that you compare that with mortgage backed securities. In mortgage backed securities, we were looking at prepayment risk being a very significant risk. Whereas here, apart from the prepayment risk, the ABS is exposed more and more to credit risk also. Apart from the prepayment risk, the because see, in case of mortgage backed security, the house, the residential property is there as a collateral. So credit risk is much lesser in that case. Whereas when I talk about a student loan, there is a good chance that the student may default also. So there is a credit risk also that is involved with respect to these kind of loan or vehicle loan. The vehicle may be there as a collateral, but the vehicle's usage, because of the vehicle's usage, the depreciation associated with the vehicle is so high that you cannot recover anything out of it. So there is a possibility of a credit risk also existing in case of ABS. So that is the reason when we are creating instruments out of ABS or when we are structuring ABS, apart from looking at the prepayment risk or apart from creating the tranches based on a prepayment basis, in MBS we have created the tranches based on the prepayment risk, like whether it is creation of sequential pay tranche where tranche X will get all the principal paid off initially, and after that only tranche Y will start getting the principal paid off. So different parties are exposed differently to contraction risk as well as extension risk. So that scenario does exist in case of ABS also. I can create a sequential pay tranche, or I can create a planned amortization class tranche, which is called as the pack tranche, wherein I can decide interval range of PSA, which would be typically paid off to the primary tranche. So if prepayments are more than that, that extra will go to the support tranche. If prepayments are lesser than that, the support tranche will be funding the pack tranche. So these kind of prepayment based tranches, either using a sequential pay or planned amortization pay tranching, can very well be done for the ABS products also, just like MBS products, which is what we call as prepayment tranching or time tranching, wherein the prepayment risk is distributed. Especially when we say prepayment risk, we always talk about the contraction risk as well as extension risk. So these two risks are distributed across the various groups of investors. But because the credit risk is also one more inherent feature of ABS, it has to be addressed through various forms of credit enhancement mechanisms. So in this credit enhancement mechanism, what we are saying is the subordinated bonds. So you create a few bonds as a senior, you create some of them as subordinated. So in this kind of a structure, if the bonds are created, then what we are saying is first comes the subordinated bonds. All the subordinated bonds will first absorb the losses. The subordinated bonds will absorb the losses to the extent of the fair value. So if subordinated bonds or have been created with a face value of some 50,000 bucks, so they will absorb all the losses to the extent of the fair value, and whatever is the excess loss, if it is, because if some of the parties default and all, there is a chance of big loss that could occur on the ABS. So whatever is the loss that is occurring on the ABS to the extent of the fair value, the subordinated bonds will absorb the loss. Then the senior bonds will start absorbing the loss from there. So which means there is a transfer of credit risk, not only the prepayment risk, there is a transfer of credit risk from the senior tranches to the subordinate. So you create tranches on the basis of credit also, so that the senior tranches will not be exposed to the bigger loss, whereas the subordinated tranches will first absorb all the bigger losses. So which means the loss absorption, we are we are varying across the various groups of investors. So whatever we are calling as subordinated bonds or support tranches kind of things, they are the ones which are going to absorb all the credit losses beginning in the beginning, and once they have absorbed all the credit losses, then comes the senior debt. So that's senior tranches. So that is how we can create a credit tranching also with respect to the ABS securities. Then, then we are looking at assessment of the prepayments versus the collateral structure in case of ABS. One thing we have to understand here, in ABS we have two major categories of assets that are backing the ABS. One is amortizing asset, then we have non-amortizing. So wherever we talk about amortizing assets, we are talking about a fixed prepayment schedule or fixed repayment schedule existing. We know how much amount has to be repaid, how much principal, how much interest needs to be repaid, and on a regular basis, probably on a monthly basis or something, the individual will be repaying the loan, which would be for the principal as well as the interest. So there is a scheduled principal and scheduled interest towards it, and the interest, so every month whatever is that equal installment that the individual is paying, some portion of it goes towards the repayment of the interest, and the balance will reduce the principal amount. And there is a possibility of prepayments very high, right? Any payment that we are making which exceeds the scheduled principal repayment is what we call as a prepayment. So typically the housing loans or like mortgage loans or even vehicle loans get into this particular category of amortizing. Whereas when we talk about the non-amortizing assets, there is no scheduled there is no scheduled principal repayment program like a credit card, right? It's not the same amount that you have to pay every year or every month. Rather, that loan is a kind of a revolving loan, right? Once you repay a minimum amount, your credit limit can increase. You can again create an additional loan. So it's a kind of a revolving kind of a loan. And there is no scheduled repayment in that. But they say that you have to pay a minimum of some amount. So there is a minimum payment amount that is suggested. And in case whatever the minimum you are paying is more than the accrued interest, then that excess will go towards the reduction of the principal. So minimum if it is greater than the interest involved, that will go towards principal reduction. Whereas if the minimum does not even cover the accrued interest, the outstanding principal balance will increase. All these things are possible with respect to the non-amortizing kind of assets. So there is a kind of a revolving thing, because especially with the credit card, I pay something, I get additional credit, so it's as if I am getting into a new loan. So depending on whether the assets that are backing my MBS are amortizing or non-amortizing, the payment structures and the collateral structures are decided. Because in case of amortizing assets, the loan pool composition does not change. So as and when people are paying in the principal and the interest, the payments are done to the investors. But so the size of the loans is coming down with every month, with every repayment schedule, but no new loans are added to the pool. Just like a mortgage loan, right? You keep paying off to the investors until those until all the mortgages are complete, until all the mortgages are until all the loans have been repaid. The same thing happens with respect to any amortizing asset. No new loans are added during the period. Initially, when the loans are finalized into an SPV, that is it. So the size of the loan pool keeps decreasing with the maturity period, but no new loans get added. And whatever the principal, the interest, and the prepayments that are being done, they are all distributed to the investors. But when it comes to the non-amortizing, whatever are the loans that form a part of the ABS pool, they keep changing continuously, because if the asset backing is credit card receivable, as and when the payment come, new loan is taken, new credit is received, they all will be purchased as a part of the same pool itself. So the compositions will keep changing, and because of that, The ABS, these kind of ABSs, they create a lockout period. They create a kind of a lockout period where they very clearly mention that the principal, whatever is received, as well as the prepayments, whatever are received during the period, they are not paid to the bondholders at all. They are not paid to the investors. Rather, they are used to buy new loans. These things are used to buy the new loans because as part of the credit card, they are more and more revolving in nature. So at least during the lockout period, no, only the interest that is paid will be paid to the bondholders, but the principal and the prepayment, they are not distributed to the bondholders. So that is one interesting aspect with respect to the ABS, where non-amortizing assets act as a backing. And if, especially if the credit quality of the collateral is not good, then there is a possibility that these bonds can be called off quite early itself. So in that case, whatever is the principal payment that is coming, that could be used to pay off the loans. In case those bonds are called off, whatever the bonds that are issued to the investors, they have a call provision. So they can be called off. That is where the amount is used to typically repay the bond holders, repay the bond holders rather than purchasing any new loans. So the ABS is exposed to a lot of prepayment risk, though the underlying does not have any kind of a prepayment risk. In case of collaterals, there is nothing called a prepayment risk. In case of credit card receivable, there is nothing called as a prepayment risk. But when we are talking about ABS, this is another thing. See, if a credit card receivable is the underlying, any prepayment that can happen on the credit card receivable, there is nothing called a prepayment risk associated because there is no scheduled principal payment that is required on a credit card payment. Whereas when I am talking about an ABS that is created on the top of that, ABS is created with a particular interest and with a particular coupon and a face value that is issued to the investors. So ABS is exposed to more and more of prepayment risk, whereas the underlying collateral may not have any kind of a prepayment risk. Another significant thing that we need to understand with respect to the asset-backed securities. Now, looking at another important aspect with respect to the ABS, the ABS are exposed more and more to credit risk also. So, there is a requirement for credit enhancements, especially with respect to ABS. There is a requirement of credit enhancement which could be internal as well as external. So these are directly depending on the credit rating that the ABS is desiring. So if the credit rating has to be much higher, the credit enhancement need to be higher and vice versa. So generally we look at two major forms of credit enhancement. One is an external, where the guarantees come to the ABS issue from a third party altogether. So basically it could be a corporate guarantee, which is more like a sponsor agreeing to guarantee, or it could be a bank agreeing to guarantee the losses to a certain to absorb the losses to a certain level, or there could be an insurance that could be taken on the particular on the bonds against the non-performance of the assets of the underlying assets. So all these things could protect the losses that are occurring on the ABS to a certain extent. So the higher these guarantees are, the better would be the credit rating that would be associated to that particular asset backed security. Now in some of these cases what could happen is, if the sponsor's credit rating is going down, the biggest problem in this mechanism, let's say, if the sponsor's credit rating has gone down, automatically the rating agencies decrease the credit rating even of the ABS. Though the collateral did not perform badly, the underlying collateral, whatever is there, that is performing the same way, but since the sponsor's credit rating has gone down, there is a possibility that the rating agencies will decrease the credit rating of the underlying ABS instrument also. That is what we look at as a weak link philosophy. Though there is no underperformance in the ABS, but because of the external credit enhancement mechanism that is there, and that the sponsor's rating has actually gone down, it should immediately result in the rating downgrade for the underlying ABS also. Similarly, we can have a few internal credit enhancement mechanisms where we talk about the reserve funds. When I talk about the reserve funds, they could be in the form of cash reserves or the excess of servicing. So when I talk about cash reserves, that whatever is the deposit that is coming from the issuing of the bonds, whatever the cash proceeds that are come, they are used as a reserve account to pay in case there are any future losses that are occurring. And in some cases, the company would be having some kind of excess cash after paying for the servicing as well as other expenses also. So whatever that excess cash is, if that is used to absorb a few losses, that is what we call as excess servicing reserve fund. Even to some extent, the losses can be absorbed by maintaining proper reserve funds within the organization or within the ABS. But of course, if the defaults are much more than that, then there is nothing much that could be done by this excess fund that is getting created. Then the other internal credit enhancement mechanism which we talk of is the over collateralization, which means if the underlying asset, the collateral, whatever we are taking, let's say the student loans, if the underlying student loans are worth 100,000 bucks, we will issue the various instruments. We will issue the various instruments only for 85 or 90,000 bucks. Means the excess 10,000 is what is going towards over collateralization. Right, whatever is the face value of the underlying collateral, it could be a student loan or an automobile loan or whatever is the face value of the underlying collateral, that should be more than whatever whatever the instruments that are being created and issued. So if the collateral value is 100 million, I go for an issue only for 90 million. whether it is for a senior tranche or a subordinated tranche or whatever it is, the total the total collateral value will definitely be more than the amount of instrument, the face value of the various instruments that I am issuing. So that amount is going towards the collateral. And the third thing is creating a senior and a subordinate kind of a structure, which I have already highlighted earlier. The subordinated bonds will absorb the losses to the extent of their collateral, whereas the senior ones will come in absorbing only in anything that is excess of the face value of the subordinates losses. So let's say in this example itself, okay, I have made an issue of 90,000 bucks, but of course in that I have created a senior, let's say for 60,000, and a subordinated, let's say for the remaining 30,000. Now what we are saying is, if the defaults are to the extent of 10,000 on that student loans, if the defaults are to the extent of 10,000, no one will lose anything here, because over collateralization is taking care of that losses. Over collateralization is absorbing those losses. But if at all the defaults are between 10,000 to 40,000, that is what is generally being absorbed by the subordinate tranche, because they have a face value up to 30,000. So they will absorb the losses which are anywhere between 10,000 to 40,000. And if the defaults exceed 40,000, then probably the senior tranche is going to absorb those losses. So because of that, the credit quality for senior tranche will be much higher, whereas the credit quality for this could be a lesser also. And this is what we call as the shifting interest mechanism. This is what we call as a shifting interest mechanism, wherein whatever is the credit protection that is offered by the subordinate tranches, they are offering a protection to the senior tranche. They are absorbing the losses, and they are offering more and more protection to the senior tranches. So that is how the credit enhancements play an important role in terms of the asset-backed securities. Now, if I have to look at different types of asset-backed securities, we'll be dealing with home equity loans, HELs. As the name itself is saying, these are the loans with the residential property itself as the underlying collateral. Then why is it not same as mortgage-backed security? If the residential property has to be the collateral, then it could very well be grouped under the mortgage-backed security itself. But here we are talking about those loans which don't get qualified for a traditional mortgage loan. So either the credit quality of the borrower is not that good, right? The credit quality or credit history of the borrower is not that good, and the loan is not qualified, like loan to value ratio, or based on the various elements, it did not get approved. Either the loan amount would have been very high compared to the property value, or for whatever reason the loan failed to qualify as a traditional loan, the traditional housing loan. Generally it comes to the root of a home equity loan mechanism. So These are some of the things. So when this is the backing collateral, when this is the collateral for asset-backed securities, generally we talk about closed-ended home equity loans. Though open-ended ones also exist, but closed-ended ones have a structure which is more and more similar to that of a mortgage itself. The only difference being the credit, the credit traits of the borrowers are the under, so they are exposed more and more to credit risk also, because the credit traits of the borrower is completely different. But apart from that, if at all a closed-ended HEL based ABS is created, the characteristics of it will be more and more similar to that of a standard fixed rate, fully amortizing kind of a mortgage itself. So basically, even this would involve a one-time lump sum loan, and the principal and the interest repayments on a monthly basis. So the prepayments, all these things could be scheduled more and more on a similar basis. But a few things that we have to understand and appreciate, especially with respect to prepayments here, is the prepayment structure. Whatever we think of for a traditional MBS may be completely different from what should be treated for a HEL. The reason being, in mortgage-backed securities, we were discussing on, if the market interest rates go lower and lower, there is a high chance of prepayments occurring in case of MBS. But when we look at the ABS, we are talking about people whose credit quality is not that great. If that is the case, even if the interest rates go down, they may not be in a position to do any kind of prepayments. Their credit quality is not that good. So there is a possibility that the prepayments may not be to that extent of prepayments in an MBS, especially when the interest rates are going down and down. So, just like the way we have used a PSA benchmark, Public Securities Association curve, to assess what could be the prepayment rates, here we have, especially for home equity loans, we talk about what is called as the prospectus prepayment curve. Another difference here between a PPC, prospectus prepayment curve, and a PSA benchmark is, PSA benchmark is more generic. Whatever we are applying, the PSA benchmark for MBS, it is generic, whereas this is more and more specific to the issuer. So whatever is the prepayment percentage and all we are talking of, that will be more and more specific to the issuer. The CPR, whatever the conditional prepayment rate associated in each of these cases, will be more and more dependent on the issuer, whereas in case of PSA, it is more and more generic. And the home equity loans can be given on a floating rate basis also, though most of them are fixed rate, fully amortizing kind of mortgages. They can very well be issued based on a floating rate also, because the underlying mortgage could be a floating rate mortgages. I could have combined all the floating rate mortgages. So, and I could have created a home equity loan based ABS, which is having a variable coupon rate. And that variable coupon rate based ABSs are called as HEL floaters. Even so, they have, based on the available funds, the typical variable coupon rate payments actually happen to them. And when we are thinking of designing a structured product out of the closed-ended HELs, we are looking at non-accelerating senior tranche. So whatever the predetermined schedule based on PPC and this non-accelerated senior tranche will receive the principal payments purely on the basis of predetermined schedule. Or else I could create a kind of a pack tranche. Pack tranche, especially if the prepayments are falling within that initial collar level, the minimum of the two layers that would be identified, the CPRs associated with the two layers. Based on that, the pack tranche would be receiving the principal payments, and the support tranche will receive any kind of prepayments in excess or in short of that particular range. Just like a typical pack tranche in an MBS, the same scenario will happen with respect to ABS also. Then, when we look at the second set of ABS, which is having manufactured houses as a backup. So, generally, when we talk about the manufactured houses, they are more like mobile homes. Important characteristics wise, they have very high levels of depreciation. The mobile homes, they have very high levels of depreciation, and when we are talking about the loans, exactly, they are also fully amortized, they are also amortized loans. But even when we talk about the cash flows that are associated with these kind of loans, we see that there is interest, principal repayment as well as prepayment. So which means these also behave more and more similar to that of a typical mortgage backed security or even a closed ended HEL. But the biggest problem is the prepayments, whatever are the prepayments, they will be more or less stable. We don't need to really bother too much about the prepayments in case of manufacturing houses, because very less chances of refinancing that is associated with them. The most important aspect for us to focus on is when we talk about the manufactured houses or mobile homes, they are not that sensitive to refinancing. So even if the interest rates fall, the chances of prepayment are not so high for these manufactured houses. Few reasons: the loan balances themselves are very small, so no benefit of getting a refinancing done. The depreciation that is associated with the mobile homes is very high in the initial years. So whatever is the face value or book value of that particular asset will be much lesser as after a few years. So whatever is the loan principal reduction that is there, compared to that, the depreciation would have been much higher, which means the assets worth is much less than what is outstanding. So no one wants to do a prepayment and then exit out. And most of the borrowers, the credit ratings are much lesser, just like your closed-ended HELs itself. Most of the borrowers will have a very less credit rating, so they cannot generally go for a refinancing kind of thing. So generally, we don't expect too much of prepayments or probably fluctuating layers of prepayments. We can be very well assured on the stable prepayments that can come in this mechanism. So that is what is one more aspect that we should look at. Then when I look at the third important kind of a category, which is a student loan based ABS. So, student loans ABS, otherwise called as SLAB, student loans ABS. So, generally they are backed by the student loans, where generally the loans that are issued under the US government's Federal Family Education Loan Program. So US government gets into this Federal Family Education Loan Program. The loans that are issued under this, based on these particular loans, the ABSs are created, which are called as slabs. Here the advantage is there is a government guarantee. So any student defaulting, there is a government guarantee up to 98% of the principal. That is what the US government talks of. So in case there is a default, the US government guarantees up to 98% of the loan principal and the accrued interest. So generally, as far as this loan, the important features are concerned, there is a deferment period. During this period, no principal repayment as well as no interest. For the first 1 year, 2 year, let's say I have taken a loan now. I am doing a 2-year course, right? For the first 2 years, I don't need to do any kind of a repayment, and no interest also is applicable during this period. Then after the deferment period, there is a grace period. That is where the interest starts accruing. Interest starts accruing, but you don't need to make any kind of payment. Probably 1 year after the completion of the study is the general grace period that is given. And that is where after that is what is the repayment period starts. So whatever the principal and the interest that get the schedule is decided at that point, and the principal and the interest payments have to be made. So the only scope for a prepayment in this case is the default, because there is a schedule for paying the interest and principal here. But if the student has defaulted on the loan, the government has to interfere, the government has to make the payment. So it makes a lump sum payment of 98% of the loan principal and the accrued interest. So the loan gets closed off there itself. That is where the scope for a prepayment comes up in case of student loan ABS. Then, when we talk about the vehicle loans or auto loan backed securities, the underlying assets and the underlying asset is the vehicle loan. Generally, we see that these are issued. Most of the vehicle loans also have this kind of period, 36 to 72 months kind of maturity, and they are also amortizing kind of loans only. All these are still amortizing loans itself. So these things, again, the principal repayment, interest repayments, all these things are the same, but the only thing is these loans can be issued not just by the banks. Even the automobile manufacturers can get into the issuance of the loans. They create their own financial subsidiaries and get into a vehicle loan kind of a process. Then we have commercial banks getting into the vehicle loan process, credit unions funding for the vehicle loans, all these things. Now, here the most important things is, where do we look at a prepayment of the loan? There is a large scope for a prepayment in case of vehicle loan, especially when I sell a vehicle. When I am selling the vehicle, I'm repaying my loan and the new guy may purchase it on cash or he may raise a new loan altogether. Means the existing loan is getting closed off or even repossessing or stolen. There is a theft of the vehicle. So the insurance company will do the complete repayment or prepayment. So there are a lot of places where the prepayment can occur with respect to these loans. So whatever, sometimes it is even possible that the borrower can use the excess cash whatever he is having to prepay off the loan. So the refinancing though may not be a major factor. Sometimes we talk about even the borrower can pay off completely if he is having excess cash, but refinancing may not be that great an option with respect to vehicle financing, because always we see that the interest rates associated with the vehicles are much smaller itself, and on the other side the loan balances are not that great. So refinancing may not result in any kind of an advantage. Just like the way we talked about the mobile housing, the loans are the loan amounts are not that high. So refinancing may not result in any kind of a better advantage. And even the vehicle, the depreciation rates of the vehicle are much higher. So after a few years, the value is much lesser than the loan that is outstanding. So refinancing will become again a difficult issue after a couple of years. So the prepayments though can occur, right? But the prepayments are majorly occurring because of borrower payoffs or sales or theft, insurance paying off because of theft or these kind of reasons, but not because of refinancing. Whereas in case of mortgage backed securities or in case of mortgages, the major factor would be the refinancing factor itself, right? Then we also have small business administration loan backed securities, SBA loan backed securities. So these are again backed with a small business administration kind of loans. And again, if the ABS is created based on this, interest, the principal repayment and the prepayments are the most common aspects. Whereas there is a possibility that most of these loans could be created on a variable rate kind of a basis itself. Whereas the most important or one of the most critical ABSs that needs to be looked at is ABS created based on the credit card receivables, because this ABS is created backed by the pools of receivables. So there could be loans that are credit card payments that are issued by banks, retailers, travel, entertainment companies. So many of them are issuing credit cards, right? So all those credit receivables are being purchased and created as a credit card receivable based ABS. And as I have mentioned, the cash flows typically in this are the interest part, which is the finance charges. There could be annual renewable fees and renewal fees and all those things, and the principal repayment. What we see is this: the principal repayments, they are not scheduled. So what this ABS typically does is it creates a lockout period during which the principal repayments are not being made to the investors. So it could go anywhere from 18 months even to 10 years also. So during this entire period, the no principal payment or no prepayments are paid to the investors. Only the finance charges and the annual fees that is coming out, they are the ones that are paid to the investors. So, but the payment wise, with respect to the underlying credit cards, there is a periodic payment schedule, but the amount is not known. And another thing is, this falls under the class of non-amortization kind of assets. So the principal is not getting amortized. In fact, it is having a revolving balance. So because of all these reasons, the credit card based ABS, credit card backed ABS will not get into any kind of principal prepayment during the lockout period. After the lockout period, it can get into the payment of the principal, and that is what we are calling as the principal amortization period. Whatever the principal repayment that the ABS wants to get into after the lockout period is what they are calling as the principal amortization period. And so after that period, whatever the principal payments that are typically being made, they can be made on one of the following basis. They can be made as a pass-through structure, just like any mortgage pass-through securities or something. Whatever the principal repayment that is coming from the credit card holder, that would be paid on a pro rata basis to the investors. That is what is a pass-through kind of a structure. Or they could be creating a controlled amortization structure after the lockout period. These are all we are talking about post lockout period. There could be a controlled amortization structure which is more or more similar to a PAC, principal amortization structure. There is a PAC window that is getting created. So basically we are creating two kinds of investors there, right? We are creating two kinds of investors. It's more similar to having a pack tranche as well as a support tranche. So there is a window that is getting created. So if at all the prepayments are high, it would be absorbed by the support window. Lower, it would be absorbed by the support window itself. So generally in this case, if the repayments are very high, or if the repayments are very low, the ABS investor receives the lower of scheduled principal payment or a pro rata portion of the principal repayment. So the other thing that could be having or that could be used is a bullet payment structure. So in a bullet payment structure, the investor will get the total principal amount in one single payment. So, but if we look at the underlying credit card, they may not pay on the whole principal in one single shot. So we are not sure whether the whole principal amount will be available by the time the bullet payment has to be or is falling due. So that is where they even call it as a soft bullet. So whatever the monthly principal payments that are coming out from the credit card holders, the ABS will actually try to invest it into an interest bearing account so that it generates the required amount of funds to be paid off under the bullet payment. So whatever the interest that is earned during the accumulation period, that is also added up and made as a payment in the initial made as a payment to the investor. So typically the structuring of the principal post the lockout period can go into any one of these mechanisms. It can go as a simple pass through, or it could go through a controlled amortization structure, or it could undergo a bullet payment kind of a structure.